Hi, I'm Scott. Welcome back. Thanks for tuning in again. This is a special little video I'm doing based around interest rates. And the reason I'm doing that is because I can see a little bit of a change happening. We're a wee way off, but basically since the global financial crisis in '07 and '08 and the subsequent recession, the interest rates have been quite low, and they've stayed low. And there's a variety of reasons, and I'm just going to talk about what I see changing. So the interest rates are partly determined by the official cash rate, which the Reserve Bank is responsible for adjusting on a 6-weekly basis. Now, if they adjust it upwards, it affects inflation, because interest rates go up, people have less money to spend, so they spend less, and inflation drops a little bit. So if they have more money, they buy more, demand increases, prices go up further. So the whole role of the Reserve Bank is to try and keep inflation within a 1 to 3% band. And during the global financial crisis and the recession that we've had, people haven't had a whole lot of extra money or cash sitting around, so they've kept interest rates low in order to spur some spending and maintain that 1 to 3% band. So, what have I seen changing? Well, in America, the economy has just started to pick up a fraction. We've started to see some good results out of there, and that has meant that they are looking to print less money. So that's a whole other side of things that we'll get into perhaps another day. But basically, if the Americans are printing lots of money because their economy's weak, that means that their supply of money weakens, and well, they've got an increased supply of money, so their dollar weakens, and that means that our exchange rate is high. Now, if the American economy does better and they start printing less money, our exchange rate will turn and come back. And we've just seen that a little bit, where it was mid-80s and it's come back down to around 80 or 81. What that means for us is that if the exchange rate comes down a little, it's better for exporters, tougher on importers. If the exchange rate's higher, importing is cheaper. So if imports are cheaper, then inflation is lower. If imports are more expensive, inflation is higher. So with that little change in America, and the subsequent change in the exchange rate that we've seen, prices may push up a little. And the one that you see it most often with is the petrol, because that changes on a day-to-day basis and it flies all around. But there's other factors involved in petrol and oil. But that's one side of things, as if the exchange rate changes. The other one that I've noticed happening in the market at the moment is that the New Zealand unemployment figure has been dropping due to the uptake of workers in the Christchurch region. With the rebuild. So it came down from about 6.8 to 6.2, I think it was, and it's forecast to come down even further. So why does that affect inflation? Well, it means more people are employed, so there's more money out there, and it means that they're going to be spending that money, and there's going to be more demand on goods and services, so prices will push up. But what it also means is that if the business owner wants to take on a staff member and expand, they're going to have to pay more for that person because there's less of a supply of people out there. It also means that people in the workplace are going to start asking for pay rises. Now, that's an extra cost to businesses. What are they going to do with that? Well, they can't operate without passing that cost on. So that means an increased cost of goods and services. So that is increased inflation. Increased inflation. Reserve Bank looks at that, goes, okay, the economy is doing a little bit better now. Why don't we just ease the rates on the OCR from that record 2.5 way down there, try and get everything going level, push it back up 2.75, 3.0 in about a year's time. So they've been saying for a long time that they're going to keep rates low for at least a year, for at least a year, for at least a year, and going on like that. Well, now I think that we're in that position where we will start to see those rates rise, perhaps in a year, maybe sooner. It's not the worst thing that could happen. Basically, if they are pushing it up, it's a case of the economy's doing better. So will it affect the housing market? Maybe, maybe not. If you look at the years 05, 06, leading up to 07 and the crash, what we saw there was interest rates rising, the economy doing better, house prices still went up because the demand was still there, because people were earning more. And of course, the more they're earning, that multiplier effect with the banks means they can borrow more, push prices up. So maybe it won't slow the house market, maybe it will, but I do see a change coming, and I think it's going to be the interest rates in about a year's time. So with the markets have already started to price some of that in, with some medium and longer term interest rates pushing out a little. So thanks very much for tuning in. I'm always really interested in people's comments, so please post your comments below. Cheers.